welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. This week, well, we really did more adjusting to our portfolio. On Wednesday's show, we went in and looked at a lot of our deep in the money option contracts with that. Most of them are tech stocks. We have the good old NVIDIA in there. Have a little bit of Google, got Eli Lilly's in there, Home Depot, Amazon. So the portfolio's done fairly well. So we had to do a lot of rolling of positions on up. And with deep in the money call options, as surrogates for stocks, whenever the delta gets close to 1, I always like to roll them up and maybe roll them out in time, depending on our outlook for the marketplace. And so we did that. So today we don't have a trade on. We don't have, well, I guess we do have a trade in the Russell 2000 index, which is doing rebalancing and just been a very busy index recently. But it expires today. And there were some opportunities to be profitable on this trade. But honestly, in Options Guide TV, we didn't maintain it as much. I wasn't looking at it as closely. It was a paper trade that we put on. But what is true about the IWM and the straddles that we have done, which is a long straddle buying an at the money call and at the money put, is well, gosh, I think 5 trades in a row we were correct on. And this trade we're gonna be down because we're gonna officially close it today on the show. And we usually try to close these trades on the shows. They're paper trades, but we talk about them and discuss them. So I'm going to go in, I'm going to close them, but I'm going to show you the chart and show the opportunities that we had with it and exactly what we were thinking. And we'll get out of that trade. And then we'll come back and we're going to do a rinse and repeat of last Friday. S&P 500 index is at 5,500, it's right almost exactly at that spot. So I like where the markets are at to do a one-day butterfly again. Now, we did it last Friday, had success with that trade. Then we came in on Monday and we did a 2-day butterfly. We went from Monday to Wednesday and had success with that trade. And now the fact that we're hanging right around this 5,500 level, I don't think we'll close on that level, but I really don't think we're going to blow out past it. And this will give us a 30-point, we'll do a 15-point wide butterfly. And it'll give us a 30-point range that the market can stay in. And the concept will be, we won't still be on the show at the end of the day, but I will definitely take a screenshot at the end of the day and see where the market is at. And when I would close the trade, I will also make note of when that would happen. So it's going to be a one-day trade and in the SPX, a rinse and repeat of last week's show. So let's get into the show. Let's go to the Tradier Pro software, and we'll pull that up. And we see here we have IWM at 203.01. So every second the market's getting a little worse. It was a little higher this morning. Now it's back down a little bit. S&P 500 index, I'll just point to it over here, the good old SPX. 45.98. Like literally 1 second ago, it was 5,500, but it's 45.98 right now. The IWM trade that we put on at the beginning of the month was we bought the 199 call. This is showing a sell because that's where it would be at to close it. But we bought that call and then we bought the 199 put. Now, at the beginning of the show, that was at 480. We put the entire trade on for 590. Obviously, the put is worthless. There's no reason to actually even close it out to try to get a penny. You might as well just let it ride for the day. The expiration is today on that position, and the way that we would go out and close this position is to this would be sell to close the call option, and this would be sell to close on the put option. I would just do the call. So I'd get rid of this trade, and this is what we'd be looking at, $3.97 to close the trade. Now, with long straddles, don't do them very often. It's usually because I like a charting scenario. I never really want to do a long straddle because of a news event, which a lot of people talk about. Oh, the stock's going to be volatile. Let's buy a put and buy a call. The stock's going to go somewhere, but that's baked into the price if it's a known news event. Like long straddles, other stocks that I've had success with is stocks like Boeing, in that they just get blindsided by news all the time. And back when when they were having the issues with the Max, you never knew when the planes were going to fly again. And they had them all grounded, and you're just kind of waiting for that news, but it's going to blindside the market when it came. So did a lot of long straddles. There were a lot of news and news headlines and everything that was hitting, and they did well. Almost all of them did, honestly. So now we're in IWM. This trade didn't do the best. We did have a situation here where the market ran to 207, but it closed at the end of the day down around 202. So if you missed that opportunity, that was the one chance that you could have closed the call side for just the call side by itself for more than you paid for the long straddle. Because at 207, intrinsically, it would have been worth $8. Now, unless you had an just random sell in for the call or for the put, and I think that is fair. A lot of times, if I can make a couple of dollars on one side of a long straddle, I'm okay with that, and then I can work the other side because you're kind of like, especially in something like the Russell 2000 Index or the IWM, very very possible. It's very very possible that the market can run up, make your call side profitable, and then come down and actually knock it out of the park with the put side. That's a high possibility. But from that point on, we really haven't done anything. So if you missed that one opportunity on the life cycle of the trade that we had, as you go through everything else, it didn't, and now it's popped up to 204. Salvaging the trade a little bit, paid $5.90 for it. At the beginning of the show, it was at $4.80, but now it's at $4. So you lost $1.80 on the trade. And I guess I would officially call this the first loser that we have in the IWM as far as the long straddle is concerned. There was an opportunity to get out, but I highly doubt that, especially considering that this candle ended up down here as opposed to up here, that you had that opportunity to get out, and you got out right at that second. All right. So let's get into the trade today. I felt like I had to address it. I haven't been looking at the IWM too much because it's been a disappointment. Here's one thing, though, that is true. So let's go back and let's recycle this. Let's go 800 and just look at, here was the channel this is the channel. We actually put on a long straddle down here. We actually bought a call straddle there. Those were two spots where we actually did trades. And in this instance, we actually thought about getting long calls because we thought maybe the market could be bouncing up. And that was when they were talking about 2 or 3 potential rate cuts by the Fed. And so the marketplace would have been, which would it's not obvious, but would be a good thing for most small caps if you get lower interest rates because they're usually highly leveraged. But then you see the volatility. I mean, look at the swings. We're going all the way down from 191 all the way up to 208, 209. And we came down and we were hanging right at this 200 level. So this was the big channel, the wild swings, and it performed very well for the Russell 2000 Index. Usually you just don't have this defined of a channel like you get in some stocks, but the Russell 2000 Index was really fun to trade in those days. But now we've got a little bit more of a defined channel, almost looking like upside down head and shoulders in this instance. But in this whole trade, you just looking for it to break either down or up in the channel. And when you pay $5 for a long straddle, all you need is a 10-point move. And that move from this bottom 99 all the way up to 209, that obviously would have done it. So the potential was there. Didn't mind the trade. Ended up being a loser in the end, unless you grabbed that one opportunity to get out on the call side of things, and then you would roll or do something with the put side, and there would have been other opportunities to do it with the put. So if you were perfect by looking at the chart in hindsight, you could have traded. If you would have traded it perfectly, you would have did just fine. SPX. Let's look at it today. 1 day. We're going to do a 1 day trade. I like butterflies on these 1 day events. The VIX has came off a little bit. It's down around the 12 level. I like it better up around the 13 level, and that's where it was last week. So the butterfly will be a little bit more expensive, more than likely, than what we paid last week. Market's at 496. I liked it right around. Well, I guess we'll do it right here. We'll come down to the 495. So usually want to do, if I'm going to do a 1 day butterfly, I usually want to use the most at the money option contract. And right now we're dancing in between the two strikes. So that makes it kind of tough, but 96. So we're going to do this one. All right. So we're going to go 15 points wide, and we're going to start. That means from 45.95, which is the strike that we're going to sell, 15 points below. And by the way, the 28th, make sure the 28th is over here. Just make sure you're in that right expiration. And it's got the W, which means that it's end of day. So you want to see the W also when you're dealing with the SPX. That means it's one of those quote unquote weekly options. So here we go. We're buying the 45.80, selling the 45.95. We're going to do that twice. And then we're going to buy the 55.10. Forward, not bad, 350. Okay, so we got $4. I like the 350. It's really dancing right now. And let me send this to the what if calculator. Pull this down. Sure, we got the right scenario, and we do. Okay, so in this trade right here, we're going to look at $3 and God, it's already down. Let's say $3. I don't mind this trade at all at $3. 15 points wide, so you got a 30-point wide swath right around here, $3. All right, that's going to be the official paper trade for today. We are going to do a at the money 1 day, half a day butterfly, looking for the market to stay somewhere between 54.80 and 55.10. If you do pay $3 for that trade, the break even on the downside, which it's very possible that this will come into play because we're only doing it for 1 day, is going to be 54.83. And the 55.10 minus $3 would be 55.07. So I'm going to write that down. 54.83 to 55.07. That is our range. If we can get this done for that $3. Yeah, it's bouncing back up. That would have been a really good fill at $3. I'm going to leave it there though, for the short term. And then if we go back to the what if calculator and we look at this trade, we're right here right now on the profit and loss graph. Now, this is as of 11 o'clock. And every hour, this is going to start skyrocketing. If you're correct and the stock stays in the middle, your profit and loss is going to skyrocket towards this pivot. So let's go 2 hours. So let's go 13:12. It's army time. And we see the movement there. Then let's go 2 more, 15:12. Now we're starting to creep up. And here's one thing that's important. So if we're going to be wrong on our forecast, right? Let's say we're completely, all of a sudden the market drops 20 points and we move outside of our range. To start with, we still have some protection because there's so much premium in the SPX index. So we're looking here as of today with an hour 16 would be 4. So with an hour to close on the market, and we still have some juice in these option contracts if the market were to go outside of the range. Now, if you go to 16, now we're going to be right at expiration. We're going to look exactly like the P&L at expiration. So SPX options really hold their premium, and it's mainly because it's such a high price index. So if you're going to be wrong, you'd want to be wrong right away because you could then just close the trade, salvage it. If I saw this thing trading for about $1. I'm going to try to salvage the dollar. I pay $3, I would salvage the dollar. But I'm going to also let this run, and if I can make $2, I'm going to get out. If I double, I've done great. I'm definitely going to get out. I'm not trying to hit the home run on this trade, which would be $15 when you're looking to sell it, which is the maximum width between the spread, and it would have to stop right at this strike price right here in order for that to happen. So if I am looking at this trade, that is, realize that the first hour of trading is very important. It's very important in that the huge time decay that can happen if you're going to do it at noon. As a matter of fact, I would usually do this maybe an hour ago, but this is when we tape Options Guy TV. And the first hour is very important. It's important that you also realize that if it does go outside your range, you want to get out. If you're trying to salvage something, you're not going to just let the trade ride, which I usually won't do, because if it goes outside of the range, it's so hard for it to come back in with the short time frame. So if it does, and you can still salvage it and still get some of those time premium early, I do that. As you get closer to the close, within the last couple of hours of trading, it gets really interesting. And if I put two of these butterflies on, two 1x2x1 butterflies, 2 units is a better way to say it. I would think about selling one early if I was up $1 and then trying to sell one later and make a couple of dollars. That would be my approach. If I'm going to trade it personally, I usually would do a 5 lot, somewhere in that range, but it's all about your risk tolerance. You got to decide what you're willing to put into the trade. So if you have any questions on the IWM trade, if you have any comments on, I see Wayne is in the chat box. Hello, Wayne. Welcome back. Let's put in, you're thinking about a Nike straddle. Put a strangle on. Okay, so hey, Brian, I'm caught in this Nike slaughter. I sold the 110 or the 9110 put strangle. 9110 put strangle expiring July 19th. Okay, so you say a put strangle. Does that mean you've sold the call and the put, Wayne? I was in the position for a few weeks. All right, let me go and look at the trade and see if we can help you out. NKE, good old Nike. Yep. You did that around earnings, Wayne. So you're short. You say a put strangle, but to me, yeah, call and put. Okay. And the 90s on July 19th. July 19th, we're looking at the 90s and 110s. Oh, wow. Okay. So we're hurting. So here's where the 90s are at. The 110s are dead. So this is our option contract. When we're 15 points, it's at 75, or it's at 76. So we'd be short this option. What could we do, Wayne? This is a tough one. 21 days here. Short the 90s are down. I mean, you can always roll, but you're going to have to really roll far out in time to try to get this to a net credit to the account. You are short this put. If you buy a long put, you're here. I would think about just getting out of the trade, Wayne. You opened it a few weeks ago. I would think about closing it out, because you're so far out of the money. It's hard to roll this anywhere and get it done for a decent price. You still got we have no extrinsic value right now. This is all time value. So we're seeing that. So there's really no time premium that's in the trade. Unless you wanted to buy the stock and hold it, I think I would just close this trade and get out of it. If anything, start another position over, because when we get to a point that your option gets so far in the money that there's really no time value left in it, it's very hard to adjust the trade. Because if you're looking to roll a trade, and this actually goes into the theme of the one-day butterfly that we were just talking about, the difference in the profit and loss graph at 10 o'clock versus 2 o'clock during the day, because of the time decay. The time is a good thing if you're losing, and it's a bad thing if you're winning. You need time to go away if you're correct on your forecast in a butterfly. So when you're in this scenario, there's really no rolling. You can put on a new position in Nike, but when you are trading at all intrinsic value, there's really no reason to try to roll it. I would close it and put on a new position that if I wanted to try to continue to trade in Nike, you could even go back and straddle it again if you wanted to, but you are kind of playing with fire here. I would definitely look at an iron condor over the short straddle, but it's gotten away from you. You have to close the trade, and that's going to be my final answer, Wade. When I'm this far in the money and I'm not really salvaging any extrinsic value or time value on the position, there's really no sense in rolling. You're deep in the money. Either you allow yourself to get put and you buy the stock at that price, or you just close out the trade and then put on a new trade if you want to stay in that underlying on that position. And that's where we're at. All right. Any other questions that we have? I'm happy to address any just one-off positions if you would like. And if not, like Wayne brought up, and I do appreciate the question, Wayne. Thanks for stopping in, as always. No more questions. All right. That's it for this edition of Options Guy TV. I will tweet out where the SPX trade is at the end of the day. And when I will exit that position, I will tweet it out if that does happen. But I will definitely grab the quotes at the close so that we can talk about it on Monday's Option Guide TV, what happened with our trade. And we'll see you, and check me out on Twitter. So now you can stream on x.com if you would like, through my Twitter handle and through the Tradier handle. My handle is @BrianOverby. You can also watch it inside the Tradier Hub. If you log in, you can ask questions inside the hub. And you can also watch it on the Tradier YouTube channel. And through the YouTube channel, you can ask questions if you are signed into YouTube via the chat box. Thanks for stopping, and we'll see you this Monday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.